as the chart showed, gold is now breaking out versus the S&P, and we have plenty of previous examples of, well, I say plenty, the one in the 1930s, the 1970s, and the 2000s. And when gold breaks out versus the stock market, from the point of breakout, you get roughly, ballpark figure, 10 years of a precious metals bull era.
Monaco 64, home of alternative economics and contrarian views. Today, I have the pleasure of speaking with Kevin Wadsworth from Badcharts, no, Northcharts, Badcharts. I think I got confused, but we haven't spoken in a while, Kevin, and we arranged this interview a while ago, and lo and behold, today gold is not surprisingly making a new high. Silver is fast approaching that 50 level. But before we go further, just wanted to say thanks for coming on again and welcome to the channel.
Hi Mario, yeah, thanks for having me back. Yeah, it's northstarbadcharts.com, so
Yeah,
so a
North.
little bit of a mouthful, but yeah, North Star Bad Charts. Yeah, we spoke quite a while back, didn't we, about the precious metals bull era that was developing and the roadmap for gold and silver to outperform stock markets. And since we last spoke, that roadmap has become even more obvious. I think it's becoming pretty obvious to many people that haven't really had their eyes on gold and silver. And as we said before we started this interview, it's um, it's more the implications of that and what it means for not just risk assets and stock markets and everything else, but what it means in terms of geopolitics as well. The fact that we're in this era that has echoes with the past. It has echoes with the 1930s, the 1970s, and the early 2000s, and we can learn a great deal from that.
Yeah, there are. I mean, I'm in the camp that thinks maybe uh, investors are starting to lose faith and confidence in the debt-based system. But there's also, I admit, the other possibility that the fast rising price of gold and silver in the last month or so could be pointing to a major geopolitical event, and by that I mean war. But before I let you chime in, I wanted to show you this chart, which I've been looking and comparing this for a while. I don't know what you think about it. This is like the value of one gold mark in paper marks, basically towards the end of World War One and into the German hyperinflation. And a few years ago, I noticed that uh, this chart here from the early 2000s looks very similar to that. Of course, it's the same fractal, I would say, but it's a longer period. And this is why I called it a disturbing resemblance. And that's why I personally think we could be heading to a loss of faith and confidence, not just in the dollar, but all fiat currencies, which are based on the dollar. I don't know if you've seen this before.
Yes, and I think I think many commentators have been talking about this for a long time. In other words, the destruction of fiat currency, which gold measures over a period of time. We know that the US dollar has lost something like, what is it, not 97% of its purchasing power since inception. It's probably more than that now, but the fact that fiat currency is constantly eroding in terms of its purchasing power. And at some point, that can accelerate away, as you saw there with that chart that you just showed. And as also we're seeing with the Turkish currency, the Turkish lira, of course. I put a chart up on social media a couple of days ago on X showing that gold in Turkish lira has moved up hundreds of thousands of percent in the last 20 years or so. And even over the last few years, thousands of percent you're talking about. So at some point, there's a kind of, what you want to call it, event horizon, point of no return, where the debt dynamics just become irretrievable. And we are edging ever closer to that point, and I think a lot of plausible deniability and a lot of distraction techniques are that's the chart there, up 117,000% in 25 years. And you know, in that same 25-year period, since the year 2000 in US dollars, we've moved from something like $250 to almost $4,000, which is nowhere near as much in percentage terms. But it's just a reminder that one by one, fiat currencies suffer the same fate. And it's a mathematical certainty that all fiat currencies, unless there's a massive intervention and a massive restructuring of the way our currency system works and the way our currency system is based, then it's inevitable that that is where we're heading. So the digitization of currencies globally and central bank digital currencies and all of this kind of stuff will be an attempt to prevent this from happening, because to have a complete collapse of the US economy almost sort of overnight in the space of a few years would be disastrous for the global community, of course. And I suppose that's the last thing any of us want to see. So something is going to have to be done, and it's either done in an honest way, an honest, open, transparent way, where the government, faces up to it and says, "Look, guys, to the rest of the world, this is the situation, and we're going to resolve the situation by whatever means," or they try and use some sort of distraction technique. And this is kind of something that history has shown in the past. I'm not a history expert, but I can see what happened in the 1930s, and I can see what's happened in previous periods when there are huge issues with debt dynamics. The period around 2008, of course, is much more recent. And what tends to happen is that the problem is hidden, brushed under the carpet. The problem is disguised in any way possible to distract the general population from the awareness of what is really going on. I've been saying this for a number of years. My background is in mathematics. My background is in statistics. My background is in the world of meteorology and forecasting. And that background, allows me to sort of look at these charts and realize pretty quickly where this is heading in a mathematical sense. But from a geopolitical sense, there's a number of options open to world leaders and to the military-industrial complex, and these forces that steer our societies. So maybe it's just a simple battle of good over evil, common sense over God knows where we might end up if we take the wrong path. I try not to think about that myself because it's quite depressing. The chart for gold, that how can I put this? Gold does nothing. It just sits there. Gold is a barometer. Okay, people call it a pet rock, and in a way they're right. It's a rock. Okay, it's an element that is pulled out of the Earth's crust. It happens to be quite rare, and it sits there and does nothing really, except it measures what is going on around it. 2,000 years ago, an ounce of gold, you could buy a fine suit. You've heard this before. And today, an ounce of gold will buy a fine suit. It doesn't do very much in between times. It goes up a bit, goes down a bit, but it just tracks purchasing power and loss of purchasing power. So measuring the US dollar against gold is useful. And people turn around and say, well, but what about Bitcoin? Bitcoin's risen a gazillion percent versus gold. Well, yes, and come back to me in a couple hundred years if Bitcoin is still here, then we might have something that's comparable. But of course, Bitcoin has moved thousands of percent versus gold because it started from zero. That's what a mining company does when it strikes gold, starts from zero and goes up by thousands of percent. So that whole argument about Bitcoin going up vertically versus everything. Well, that's in the past. That's in the rearview mirror. That's not the future. That's not the present even.
Before we proceed with the interview, I just wanted to let you know that there is a Rudy Collection merchandise store for the channel. There are mugs, shirts, hats, cushions, and the Fed mugs, get stacked mugs. So yes, check out the link below in the description.
And you can realize that just by pulling up a chart of Bitcoin versus gold and noting that it's showing rapid decay versus gold. So we've got a capital rotation process taking place, and it's very much along the lines of previous capital rotation processes. I can share a couple of charts from my feed on X and just talk you through it. It's probably the easiest way of doing it. So I'll just see if I can get my screen sharing switched on. Make sure I share the right screen because I've got a few different screens here. Um, okay, right. So what you should be looking at is my X feed, and the very first thing at the very top of my feed here has been there for a year now, and it says, "Ignore this at your peril. It's going to hit us between the eyes." And what is it? It's capital rotation, and it's telling you all of these things are in a bear market versus gold. We're talking about US money supply. We're talking about the US dollar index. So US dollar relative strength, that's what DXY is in a bear market versus gold. Consumer prices, producer prices, currency in circulation, the equal weighted S&P 500, the New York Composite, the Dow Jones, the Wilshire 5000, the Russell 2000, and now the S&P and the Nasdaq are breaking down versus gold. When all of these boxes are red, you have a confirmed capital rotation event. It says so in the text underneath. And what happens when you have a capital rotation event? Well, we had one in the 1930s, we had one in the 1970s, and we had one roughly 25 years ago. Capital rotation events lead to gold outperforming stock markets for at least a decade, and it also implies stock markets not doing anything very exciting for 10 to 15 years. So you get a series of rallies, a series of drops over a 10 to 15 year period. But overall, the S&P, for example, will not make new highs for a 10 to 15 year period. Okay. And that's how the capital rotation process operates, because the money flows that would otherwise be powering the stock markets much higher, they are being, to a large extent, redirected elsewhere, not just into gold, but into silver, platinum, palladium, into the commodities, oil, energy, all of these related sectors that will have their bull eras at the same time as gold. And as I said, I mentioned oil there, and oil has its bull phases during the precious metals bull era. So the implications there are that sometime over the next few years, you would expect oil to go on to a big move. Um, this is the capital rotation process made a lot more sort of clear for you. And you can see this is a gold versus S&P chart. And you can see that when the ratio goes up, gold is outperforming the stock market. It happened, if I scroll back further, you can see it happened in the 1930s. It's happening here in the 1970s in a way that looks very similar to the way it's happening now. In the early 2000s, you had more of a V-shaped um, surge to the upside that meant gold was outperforming the stock market. And these very rapid upside moves are often powered by the stock market dropping. So when the stock market rolls over and falls, as it did then, 50%, that powers the ratio to the upside and puts us into an era where gold is outperforming the stock market. Now, you don't need me to tell you that the stock market hasn't fallen 50% yet. It's still powering upwards in a sort of a melt up phase. And I've got to give some credit to Henrik Zeberg here, who, amongst a fairly small number of people, has been championing the sort of melt up phase of stock markets for quite a while. And this terminal phase for the stock markets, it's clearly, I think, when you look at it on a whole variety of metrics, is the final phase of this economic cycle where the stock markets, and we could well have the stock markets, gold, silver, all going up together. That's what they've been doing. In fact, gold, silver, and stock markets have been going up, and cryptocurrencies as well. So that could continue for a while. We don't know how long. If I'm, put my hand on my heart and I'm honest about it, I don't know exactly how long everything is going to go up together. What I do know is that it's going to lead into a precious metals bull era and the stock markets um, will suffer as a result of all of that. This chart kind of sums up a lot of it as well. It's the 10-year yield minus the 2-year yield uh, chart for the US. So it's the yield curve inversion chart. And when the chart is below zero and the 10-year yield minus the 2 yield is negative, you get a sort of a return to mean after a while where the chart crosses that zero line again. Now, the dynamics behind this are related to the debt dynamics and long-term and short-term inflation expectations and all that kind of stuff. So that combination of debt dynamics and inflation expectations, when the 10-year yield minus the 2-year yield re-emerges above the zero line, you tend to get some kind of geopolitical event, but you also most certainly get a recession. Now, you need to combine this evidence with other pieces of evidence to try and tie down when the recession is most likely to come along. And I think it was was it Bloomberg or Morgan Stanley's, one of the um, economic monitoring organizations and commentators have said that we actually went into a recession um, last April, in fact, by some of their metrics. What I'm saying here is that a recession, or possibly something worse, is staring us in the face. And you can look at jobs numbers. You can look at a variety of metrics that kind of reflect this as well. So it appears that we're heading towards something unpleasant. And the type of geopolitical backdrop where we've had things like the dot-com bust and GFC subprime crisis and all the rest of it, I've started to label this as a breakdown of the established world order, multiple wars and geopolitical economic shocks. The current situation is that we have a high likelihood of a series of high impact events. And that is going to be ongoing, I think, for a number of years. This is not this matrix in the top left-hand corner. Um, it kind of relates to a series of pieces of technical chart evidence, like gold accelerating rapidly in the way it has done, like the jobs numbers, like the debt unsustainability. If you look at the 10-year yield itself, we've seen the 10-year yield breaking out of a 40-year downtrend and is now in a new paradigm where the 10-year yield is up around 3, 4, 5%, and with a tendency over the next 2 or 3 decades to want to rise further. And when you have debt to GDP north of 120%, that's a major problem. So, you put together lots of pieces of evidence and it starts to tell you that the likelihood of these major geopolitical events is much higher than it has been over previous years and previous decades even. So you often get this plausible deniability and distraction type of stuff going on where, it's almost as though that trying to create mini crises to distract from the truth of the matter, which is purely mathematical, really. Mario, it's a mathematical issue, it's a mathematical problem, and it's not something that you can solve easily. I'm not going to say that there's some sort of magic answer to this. Silver itself is crossing what I've labeled as a Maginot line there, the weekly defined resistance at $48. And when you do the same exercise with the monthly chart, it turns out that the red line, resistance line on the monthly chart for silver is at 55. So any kind of clear move above 48, and the next target is 55. And with both gold and silver, we can't say with any great deal of certainty where this is going to stop before the next significant correction. But it's a global event that's taking place. This is gold in world currency units. That we it's almost vertical. I mean, I don't know quite. At this point, I'm almost lost for words because I've kind of known this was coming, and I've drawn the roadmaps, and I've kind of shown that gold and silver, well, the silver roadmap, for example, to $50, which has played out very nicely. It's probably on my timeline here somewhere if I scroll down. But the silver chart, here we go. Um, the 44-year cup and handle chart projected to $50 by 2025, 2026, very, very clearly. And this was back when it was somewhere around $21, $22. So it's played out exactly as we expected it to, but when it comes down to it, and you're sort of in the middle of this huge upside move, it does sort of take your breath away a little bit, and leave you sort of kind of in awe that
I've
oh
been sorry,
yeah,
yeah, I've been involved in gold and silver since '02, and I mean, it was a good time to get involved, but it always seems like there's a force trying to like control the price, and now it feels like that force is gone, and like you showed that chart of gold versus world currencies, yeah, and it looks like this is it. But you mentioned silver there, the teacup and handle, and I was looking at it, Kevin, and let's see if I've got it here. I'm going to share it with you. And I did the same chart, and I don't have a time objective, of course, but if you take the distance from here to the top, that's like 1300%. So if you do like 51 or 52 times 1300%, you get around 650,
yeah,
which is usually the objective on the teacup. But as I said,
yeah.
I don't know if it's going to happen in 2 years, 3 years, or 10 years. The thing is that this formation took 45 years, right? So, yeah, what do you think? You think it's going to take quite long to go to?
Yeah, so the answer to that is actually relatively straightforward, believe it or not, and it comes down to that gold versus S&P ratio chart that I showed you. And as the chart showed, gold is now breaking out versus the S&P, and we have plenty of previous examples of, well, I say plenty, the one in the 1930s, the 1970s, and the 2000s. And when gold breaks out versus the stock market, from the point of breakout, you get roughly, ballpark figure, 10 years of a precious metals bull era. So whatever is going to happen with gold and silver is going to happen roughly. It might be 8 years, it might be 12 years, it's a ballpark figure, but we're not talking about 2 years and we're not talking about 25 years. We're talking about a sort of a 10-year period. Now, in the fullness of time, if we were to live long enough, gold and silver, assuming we stay in the same monetary regime, they will just keep going up and up and up forever. Well, at the end of this 10-year period, there'll be another, era where the stock market's outperforming gold and silver correct by 50%. But then they'll enter another bull phase where they go up by another 1,000%, So it goes on and it goes on and it goes on until the currency system dies, basically, is what I'm saying. But assuming our current system of currency does not collapse or does not turn into something drastically different, um, then the ultimate destination will be reached in roughly 10 years' time for the price of gold and silver. Whether they come along before that and revalue gold and silver to avoid some kind of collapse, we'll have to wait and see. There's a lot of unanswered questions there, but that 10-year time frame is a reasonable expectation. And your $650 for silver might sound stupid to a lot of people, but just look at the percentage gains for silver in the past, and take it one step at a time, because there are targets before you get to 650. There are targets that you can identify using a variety of techniques, Fibonacci extension levels, measured moves. You could look at the depth of the actual handle on that cup and handle pattern. That would be one of your earlier targets. You measure the depth of the cup there. You can actually also measure the depth of the handle, and that would be one of your interim targets. So they're going higher. They're going much higher. Um, how much higher? Um, and whether anything disastrous happens in the meantime does remain to be seen. But all things being equal, we've got a good roadmap to where we're going.
Seeing that your background is in statistics, meteorology, uh, you were speaking about a melt up, which I think we're having right now because but gold is going up faster than the stock market and the bond market. What do you think is the probability that we continue to see the melt up? And most people will not realize that they're actually losing purchasing power because the general stock market is going to be going up slower than gold and silver.
Yeah, I'll quickly try and shed some light on that. So I'll just show you a live chart here now. That's the silver chart I showed you. If I put in the S&P 500, and I'll show you what I mean by a melt up, and I'll just zoom in a little bit for you so you can see it a bit more clearly. So this is the S&P 500, and a melt up, the way is okay. What do I mean by melt up? What's the definition? The definition to me is when you are breaking to the upside from an already extended and rising price structure. So if the price is already going up and is already in a bull market, and if I zoom out, you can see we are definitely in an ongoing bull market with the price rising from bottom left to top right. And melt ups happen when you get what you would expect to be a bearish pattern, a bearish rising wedge sort of pattern. If I just make that upper line red for a moment, and you look at the lower red line or even the lower black line, it's a rising wedge pattern. It's wider at the bottom than it is at the top. And usually those sort of rising wedgy type patterns, they sort of resolve to the downside. When you get an upside break, and we've been seeing this in gold and silver as well, by the way, although the outcome is going to be different eventually. Um, when you get an upside break of a bearish pattern, it can often and usually is quite an energetic and rapid upside move that moves up even more quickly than you have been already. So that's how I would define a melt up. You often get it in an energetic bull market, and they often mark, not always, but they often mark the very end of a bull market move. And you can do the same. The Nasdaq is exactly the same. If you look at the Nasdaq as well, the tech stock index, the Nasdaq is also. And if I just put it on the candle chart for you, there you can see it's breaking upwards from a bearish rising wedge pattern. So that to me is sending one of many warning signals that this could be sort of the end phase. But if you look at Nasdaq versus, and I'm just going to your point about losing, picking the winner, if you like. If you look at the S&P versus gold, that's the S&P versus gold, and it's just been going down and down and down and down and down. So the S&P, it actually peaked versus gold 25 years ago up here. So the S&P peaked versus gold in the year 2000, and despite a bit of a recovery over the sort of period post 2011, it is actually breaking down again now, or it's very close to breaking down on this monthly defined basis. So that's how I'm analysing the S&P versus gold at the moment. So 10 to 20% probability that it turns around and goes into a sustained upwards move versus gold, and an 80 to 90% probability that it breaks down, and whether it might bounce a little bit higher. It could come up here, for example, but the long-term direction is for a downside break, and the S&P losing even more versus gold. So, I mean, step back for a moment and you look at it over the last several years, the S&P hasn't really made any ground versus gold. It's gone up and down and up and down, but it's just gone sideways overall. And gold versus Nasdaq, same sort of story. We've got a probable capital rotation taking place here, with gold breaking to the upside versus the Nasdaq, just as it did back here in the early 2000s. So you get these rotation events where there's a breakdown and you rotate into tech stocks, and then it breaks out and you rotate into gold, and it breaks down, you rotate back into tech stocks, and then at that point you're looking for the next upside breakout where the price goes upwards through the Ichimoku cloud, which I just put on the chart, and upwards through the 3 and 4 year moving averages. Um, I'll put the 3 year moving average on the chart there. So um, bull markets are defined by the chart being above the Ichimoku cloud and above 3 and 4 year moving averages on their long-term charts. And this ratio chart is now above the moving average, and it's close to breaking out above the top of this Ichimoku cloud. So once we get to that black dotted line and we start moving a bit higher, then the capital rotation is fully confirmed, and you can say with certainty that we're now in a phase where gold is going to be outperforming tech stocks for many years ahead. And something that just before we move on from this, um, I'm just going to show you something that might surprise a lot of people as well when we talk about the stock market. Um, the stock market, the S&P, has 11 sectors. Communication services is one of them, and it is in a bear market versus gold, a clear, very clearly defined bear market versus gold. Consumer discretionary is another sector of the S&P. It is in a clear bear market versus gold, very, very clear breakdown, very, very clear bear market. XLP is another sector of the stock market, consumer staples, now in a very, very clear bear market, a well advanced bear market versus gold. We've got XLE, which is energy. It's in a permanent bear market versus gold, really. You get the occasional upside uh, moves during a precious metals bull era, and we will get one at some point where energy starts to outperform gold for a while. But at the moment, it's in a very clear bear market versus gold. XLF is financials. That's the clearest breakdown you could hope to see. Break down below support, break down below the long-term moving average, break down below the Ichimoku cloud. We're in a bear market priced in gold. XLV, which is healthcare, that's a very nasty capital rotation taken place there, where gold has massively outperformed healthcare. I mean, you can measure the distance from the top to the bottom. So far, 55% outperformance of gold versus healthcare. We've got the XLI industrials. That's another sector of the S&P. That's in a bear market versus gold. We've got materials. That's another sector of the S&P, bear market versus gold. Real estate, absolute disaster. Real estate is actually now very cheap, priced in gold. Sometime in the next, between now and I would say maybe 2, 3 years' time, be a great time to rotate gold into real estate because we're historically cheap versus real estate at the moment, and that will begin to rotate at some point in the future as well. So that's one to keep an eye on. The only one that is actually holding up at the moment out of the 11 sectors is tech. The big tech stocks, the Mag 7, are holding up the entire capital rotation event. Without them, we would be collapsing at this stage. But even tech is showing some signs of weakness here below the moving average and moving below the Ichimoku cloud there. So should this megaphone pattern ever break down, then that would be pretty disastrous.
I
Uh,
guess
fi-
I,
Finally, just before you, that's XLU, which is utilities, which is in a disastrous bear market as well.
just to, sorry to interrupt you. So that's why you think the S&P uh, Dow, S&P Gold and Nasdaq Gold have an 80 to 90% chance of going lower and not up, because it looks like you said, only tech saves itself. Everything else is in a bear market. Have you ever looked at U.S. GDP in terms of gold? That would look pretty bad too, wouldn't it?
Yeah, I've got that chart there somewhere, but I can
Yeah.
just rather than looking for it, I can do that one for you. So that's US GDP. Um,
I guess
I
that's
think
in a recession.
versus, versus XAU USD. So let me just see. There you go. So that's US GDP versus gold.
Yeah.
And as you said, it looks terrible. GDP, by the way, that's GDP is money supply times money velocity. if I pull up a chart for GDP and I overlay money supply multiplied by money velocity, it's the identical chart. So GDP, in truth, from a mathematical point of view, you can only increase GDP in two ways: increasing money supply or increasing the velocity of money. There's no other way of increasing GDP. We think of GDP as the sum total of productivity or whatever, however you visualize it, output, industrial output, whatever, the country's production. But it is actually in its raw um, definition, it's money supply times money velocity. So either we print to infinity or we somehow get the velocity of money to go up rapidly, leading into a recession. I'm not quite sure how you get the velocity of money to rapidly increase. So that really only leaves one option, doesn't it? Um, this whole capital rotation thesis started with me with charts like this. So that is the money supply to gold chart. So money supply to gold broke down back here, and that's when I sat up and said to everybody, well, here's a huge piece of evidence that with gold somewhere near 1800 dollars, we're heading into a massive gold bull era. And I put this chart out there, 5 years ago, and we started to track it. And of course, that piece of evidence was joined by charts like DXY, US dollar strength breaking down versus gold. And that is something else that happens in a gold bull era. It happened in the early 2000s, and it happened all the way back here in the 1970s as well. You can see how the chart plummeted to the downside, and that's spotting these correlations and spotting what happened in past gold bull eras is crucial to understanding where we're going over the next few years. This is gold versus CPI, and we're pretty familiar with that chart. It looks quite similar to the gold chart itself. Gold versus PPI, producer prices, it's the same thing. Currency in circulation versus gold has broken down, and this chart moves down very strongly during the precious metals bull era. Here's the one in the 1970s, and here's when gold went from 250 to $1,900. So, the signal from that chart is that we're in a gold bull era. The equal weighted S&P versus gold is in a dramatic bear market. You can see it plummeting below key support, below the moving average, below the Ichimoku cloud. So this roadmap, which I put out a while ago, a couple of years ago, is playing out very nicely. Gold versus the New York Composite is moving to the upside. The Dow Jones versus gold is a really important chart, actually, because it gave four signals. Well, it's given three signals, and this is the fourth one. And if I just try and resize it a little bit for you so it's a little bit easier to read. Here's Dow to gold. Signal number one was in 1929 when the stock market was about to drop by, what was it, 80% or more. And at the time, gold had to be repegged higher because of the forces that were being exerted on the gold market. Even though gold was pegged, it had to be repegged 70% higher, more than 70% higher. So the chart plummeting there was pushing us into an era where stock markets collapsed and gold went up a lot. The second signal came in the early 1970s when the chart broke down again, and the S&P dropped 50% and gold rose by nearly 2,500%. Signal number three came in the early 2000s when the chart broke down. Then it broke down clearly below the moving averages in the Ichimoku cloud. Gold doubled, and then it doubled again, and then it doubled again. Well, when gold was below $2,000, I said it would double, and then it'll double again, and then it'll double again. Well, it's done its first double. It's already doubled. So it's going to double again from here to $8,000. And then I fully expect it to double again after that from 8,000 to 15 or $16,000. So that would be my estimation of where we're going to end up with gold. We are now below the quarterly long-term 24, 36 period moving averages, below the quarterly Ichimoku cloud, below critical support. So yet another signal,
Yeah,
Mary,
are you
of
Yeah, sorry to interrupt you. Are you of the opinion as well that this kind of reset will like be finished when the Dow and gold are at the same price? Let's say six
Yeah, Dow gold equals one.
or even less. I mean, you could have 1 ounce of gold by a half an ounce of gold or three-quarters of an ounce by one Dow.
Yeah, it's I'll show you something that might just shed a bit of light on that from a technical chart point of view. And this is just well, I was going to say it's speculation, but it's a bit more than that, I suppose. Let me just DJIA. Um, I'll tell you what, hang on a second. I've got so many charts and so many lists of charts on here, and so many different layouts. Let me just get that Dow to gold ratio again. Right. Okay. So this is the Dow to gold fourth event, as I just showed you, event one, event two, event three, and event four. So if I was to, let me just get rid of the label out the way from there. And let me just get rid of that for a second. We've got a technical chart pattern here that is worth, um,
Megaphone, I guess.
yeah, worth bearing in mind. So that bottom line there is not a support line. Well, hang on, let me just extend that. It's not the clearest of support lines because you sort of need three touches to um, cement a support line as being valid, and we've got one, two, and then back here, I suppose you could argue that these are valid touch points there, one, two there. So if this is valid, then your sort of target area would be down here somewhere. And I've said 10 years, so we're talking about the mid 2030s. So somewhere, something like that. And you can see that previously we have fallen at exactly that angle.
Yeah,
That sort of angle is not unreasonable. So that's the roadmap.
yeah. Event three there was stopped because of QE, would you say?
Yes. So it's interesting, isn't it? At that point there, you would have sort of said that the roadmap is like that.
Yeah.
And something happened here. Clearly, you're right. In 2008, of course, we had the financial crisis. In 2011, we had a whole series of um, interventions in the markets. But time had run out. We'd had our 10-year precious metals bull run, and time ran out. Starting from that very high starting point, we just did not have enough time to get all the way down to the support line. What's happened since 2011 is a sort of nascent recovery, a sort of a tepid recovery that has given us a lower high compared to this one. And the fact that we've got a lower high and we've rolled over and broken down tells us that this was, from a technical point of view, just a pause in an ongoing
So
event that
I
hasn't.
guess it's still quite, I mean, there's a talk now. I saw an article in the FT talking about gold-plated FOMO that, and I think we're gonna hear a lot of that in the next few weeks or months that gold is overdone, that it's finished. And of course, we'll have corrections, but from what you showing me, there's a long time to go still in this precious metals bull.
Yeah, the roadmap, the most likely scenario at the moment, based on historical evidence, is that we have a 10-year, approximately 10-year bull run for precious metals from here. And I know it's fun to sort of speculate about where it might end and where these ratios might be, but the better way to sort of to visualize it in your mind is that look, I don't really mind how far down it comes, whether it gets down to the bottom or whether it doesn't, as long as I can spot when it's over. So you need to be able to spot when it's finished and when that turn happens. And look, the bull runs for gold versus the stock market happen when this black line is above the moving average in the Ichimoku cloud, above the moving average in the Ichimoku cloud, above the moving average in the Ichimoku cloud on every single occasion. That's the definition of
Yeah,
the precious metals bull era. Sorry, that's the definition of the stock market bull era. And the bull era for gold happens when the black line is below the moving average in the Ichimoku cloud. So you can identify very clearly, and it, here, for example, that was when gold went bonkers.
yeah,
Here is when gold went bonkers. Same thing back here. Gold went crazy, silver went crazy. Here, it's when the black line is below the Ichimoku cloud and the long-term moving average. So as long as that is still the case, and we're below the 3 and 4 year moving average, and we're below the Ichimoku cloud on this ratio chart for Dow versus gold, then there's nothing to worry about.
yeah. How do you get the Ichimoku?
The Ichimoku cloud, well, it's one of the technical indicators on TradingView. So you just go into the indicators, metrics, and strategies, and you can just search for it if you want to.
I
Um,
have to
I've saved it as a favorite, and I've slightly changed the colors to make it a little bit clearer. You can fiddle around with the settings to make the Ichimoku cloud a little bit clearer. But the settings I've got it on is 9, 26, 52, 26. Those are the sort of time periods
yeah,
for the Ichimoku cloud. So it's a Japanese technical indicator. You can read, you can Google it and read about what the Ichimoku cloud is. It forward projects. You can notice it's actually projecting the Ichimoku cloud into 2027. So it's forward projecting future resistance. And the cloud has turned red, which of course is what you want to see it doing, because when the cloud turns red, it's indicating that you're in some kind of a developing downtrend. And we want this ratio to go down, because if the ratio goes down, it means gold is outperforming the Dow Jones. So, it's doing what we want it to do. And as long as the black line, the ratio is below the Ichimoku cloud and the 3 and 4 year moving averages, then we've got no
yeah,
concerns about the long term,
yeah.
our long term forecast.
What do you mean by 3 and 4 year moving average?
So yeah, so when you're looking at long-term charts of multiple years and multiple decades, um, the 3 and 4 year moving averages are important, because well, gold has a 4 year cycle. Actually, it has a sort of has a 7.5 to 8 year cycle, and so therefore the 3 and 4 year moving averages um, are important for gold as a sort of an indicator of whether you're in a bullish or a bearish environment. If
Yeah,
you're above the 3 and 4 year moving averages for gold and gold related ratios like this one, then it's an additional piece of evidence that you can be bullish. And if you're below those moving averages, it's an additional piece of evidence that you should probably be starting to turn less bullish.
when are you
There,
because
there's, I was just going to say there's no single um, golden nugget that will, there's no single thing that you can say above this you're in a bull market and below this you're in a bear market. What you have to do is use a sort of a weight of evidence and bring all the evidence together. And what it tells you, a bit like a weather forecast, is what's most likely to happen in the next few years, not what will happen, but what is most likely to happen. As an example of that, just looking at this chart here, you can see back here in the late 1990s, we had an upside breakout of the ratio at a time when the ratio was above the moving average and above the Ichimoku cloud. So that would have told you at the time that you're much more likely to see a significant sustained upside move than any kind of negative downside move for the ratio. So you're constantly looking for those sorts of pieces of evidence. And we've had one very recently as the chart broke down, and it even back tested the breakdown for us. If you put it on the candle chart there for you, um, you can see that, and I'll just try and get the positioning of that line as accurate as I can. We saw a breakdown below that black line, and it happened when we were below the moving average and below the Ichimoku cloud. That's the precise opposite of what I just showed you there,
yeah,
where we had an upside reaction above the average and above the cloud. So we knew that the Dow Jones was going to outperform gold going forwards. Now we've had the exact opposite of that, where we're getting the downside confirmation below the moving average and below the cloud. So it tells us that, it doesn't tell us what's going to happen in the next few weeks. I mean, gold could correct significantly over the next few weeks or next few months. But what it does tell you over the next few years, that the trend is highly likely to be to the downside.
Okay. Well, that's great. Yeah, we should talk more often, Kevin. And anything you want to tell the viewers about your service and where they can find you?
Yeah, sure. I mean, there's lots of great sort of technical analysis services out there, and if what I've been saying sort of strikes a chord with you, then why not give us a try? We'll probably be having some sort of promotional campaign for Black Friday when it comes up. But you can find us at northstarbadcharts.com, and a whole bunch of technical analysis that covers all of the markets. You know, it covers stock markets, gold, silver, it covers commodities, and we have entries and exits and detailed trades and a whole host of stuff on there. So yeah, feel free to try us out, and of course, a lot of free stuff as well on my social media on X, where you can find me at North Star Charts, Mario.
Great. Thank you, Kevin. Hope you have a great week and yeah, talk to you later.
Yeah, thanks, Mario.